This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show!
So we are tracking an investor today who they basically flushed their entire hypergrowth AI-driven tech portfolio to buy IBM and Johnson & Johnson.
Yeah, it's a massive pivot.
It's an incredibly aggressive pivot,
Yeah.
right? And we actually have the portfolio snapshots to prove it. But before we take a single step into the mechanics of this trade, I need to put a giant flashing neon sign right at the front door.
Oh, for sure. The disclaimer.
Exactly. Today's discussion is based entirely on an anonymous investor's portfolio snapshots that we, got our hands on. Everything we are about to talk about is strictly for informational and educational purposes only. Let me be incredibly clear here. This conversation does not constitute financial, investment, or legal advice of any kind. You absolutely must consult with a certified financial professional before you make any personal investment decisions.
Right, so the legal guardrails are firmly in place.
Absolutely. So welcome to the deep dive. The mission today is, it's completely fascinating. We are tracking a real-time, rapid-fire portfolio overhaul. And I mean rapid.
Yep, it didn't take long at all.
No, not at all. We're looking at an investor who was basically strapped to the AI and semiconductor boom,
Right.
just riding it all the way up, and then executed a total structural change in philosophy.
Like a complete 180.
Yeah. The best way I can describe it is that this investor woke up, looked at their massive paper games, and decided to just flush all the high-octane rocket fuel right out of the engine. And in its place, they loaded the hull with heavy, stabilizing ballast.
That's a great way to put it.
Right. We are talking about moving from pure headline-dominating tech to bedrock, reality-based defensive value.
Yeah, and if we connect this to the bigger picture, what we are really analyzing here is a masterclass in tactical de-risking. Because, well, it's one thing to ride a bull market. Anyone can buy a hot stock when an entire sector is just surging on some new narrative.
Oh, definitely. Everyone's a genius in a bull market, right?
Yeah. Exactly. But knowing when to step off the ride, knowing when to take those exciting hypothetical numbers on your screen and convert them into tangible long-term stability, that requires an immense amount of psychological discipline.
It really does.
And I think this case study is so relevant for you right now because it demonstrates the mechanics of managing risk before the market violently forces you to.
Right, before the crash. So let's look at what I'm calling the starting line. When we examine the initial snapshots of this anonymous portfolio, it is heavily concentrated in the artificial intelligence wave. We are talking about pure play, high beta growth names.
Yeah, and we should probably clarify high beta for anyone not, staring at stock charts all day.
Yeah, go for it.
So when a stock has a high beta, it essentially acts like a magnifying glass for the broader market's movements. Like if the overall market goes up 1%, a high beta tech stock might shoot up 3%.
Which feels amazing on the way up.
Oh, it feels great. But the catch is that the reverse is also true. If the market catches a cold, high beta stocks catch pneumonia. They are inherently volatile.
And that volatility is a perfect segue because at the top of this original roster, you've got NVIDIA and Palantir.
Oh, yeah.
Literally the absolute poster children of the current AI hype cycle. And the tech footprint didn't stop there. Beyond the pure AI plays, they built a massive semiconductor foundation. They were holding Taiwan Semiconductor, TSM, alongside ASML.
Heavy hitters.
Yeah, and wrapping all of that up were giant tech stalwarts like Alphabet and Palo Alto Networks.
Honestly, looking at this starting allocation, it reminds me of someone driving a highly tuned Formula One car on a public highway.
Built for pure speed, but incredibly fragile.
Yes, like when the track is straight and the macroeconomic conditions are perfect, you are going to outrun every single person on the road. You are generating massive wealth in a really short period.
But because that machine is so highly tuned and so dependent on a specific set of conditions, you have absolutely zero shock absorption. One bad inflation print, one missed earnings whisper, or, a one shift in interest rates, and you're spinning out into the wall.
And to understand why someone builds a portfolio like this initially, you have to look at the mechanics of a technological paradigm shift.
Okay.
Whenever a new general-purpose technology emerges, so think of the build-out of the early internet, the shift to mobile computing, or in this case, generative AI, the market systematically rewards the pure-play innovators first.
Because everyone is just piling in.
Right. Investors pile in to capture the maximum upside during that explosive initial phase of adoption. You buy the rocket fuel because you are trying to reach escape velocity.
You want the companies actually building the engines of the new economy, not the ones just, using them.
Exactly that. But the underlying problem, and the reason this investor's pivot is so crucial to study, is that markets are ruthlessly cyclical. What goes straight up, propelled by immense hype and future earnings projections that stretch like a decade into the future.
Which happens a lot in tech.
Yeah, it can come straight down just as fast when reality sets in.
Wow.
When the macroeconomic environment shifts, those high beta premiums just evaporate.
Right. Okay, let's unpack this, because that exact vulnerability, that risk of a high-speed crash, is why the investor suddenly slams on the brakes. We see the first wave of the rotation, the initial ejection from the hype.
They get out.
They completely liquidate their positions in NVIDIA and Palantir, just entirely wiped off the board, cashing in the chips. And they take that capital and they initiate a brand new 5-share position in IBM and an 8-share position in the SCHD dividend ETF. Now, I have to step in and challenge the logic here.
Let's hear it.
Well, if you are an investor who clearly understands the revolutionary power of artificial intelligence, which they obviously do, given they were riding NVIDIA and Palantir to the top, why on earth would you swap out the very brain of the AI revolution for IBM?
It does seem counterintuitive.
I mean, you are trading the hottest technology on the planet for the company that made my dad's clunky ThinkPad laptop in 1998. To a lot of people, IBM is the definition of legacy. It feels like trading a Ferrari for a used station wagon.
Yeah, but what's fascinating here is how completely misunderstood the concept of boring is when we talk about long-term wealth preservation.
Oh, so?
Well, people attach that boring label to IBM because the company is no longer selling flashy consumer gadgets or generating viral headlines on social media. But if you look under the hood at the actual mechanics of IBM's business model today, it is deeply entrenched in enterprise software, hybrid cloud infrastructure, and quantum computing.
Ah, so we are talking about business-to-business infrastructure, not consumer products.
Right. It is the ultimate backdoor foundational tech play. Instead of trying to guess which shiny new consumer AI application will win the market over the next 6 months, IBM provides the massive, heavy-duty digital plumbing that Fortune 500 companies use to keep their daily operations running.
Oh, that makes sense.
And the key mechanism here is what we call switching costs.
Meaning, once a company starts using IBM, it's just too painful to stop.
Exactly. It is a multi-year, billion-dollar headache to migrate a global bank or an international airline off of an integrated IBM mainframe and software ecosystem.
Yeah.
So they just don't do it.
They just pay the bill.
They just keep paying the recurring revenue fees year after year. That sticky revenue provides a massive concrete floor to the stock price that consumer-driven tech companies simply do not have.
It's the classic strategy of selling the pickaxes instead of mining for the gold. But in this case, they're selling incredibly heavy, unglamorous, industrial-grade pickaxes that the miners literally can't operate without.
Perfect analogy. And then you have to look at the second half of that initial trade. They paired that 5-share IBM entry with 8 shares of SCHD, the Schwab U.S. Dividend Equity ETF. This introduces a completely different financial mechanic into the portfolio.
The dividend aspect.
Yeah, when you buy into a dedicated dividend ETF, you are making a profound philosophical shift. You are essentially telling the market, look, I no longer need my principal investment to double in price for this to be a successful trade. I am willing to cap my upside in exchange for a guaranteed, steady drip of cash.
So it anchors the portfolio. You're getting paid to simply wait.
It's the very definition of the ballast we talked about earlier. You are putting heavy lead weights into the bottom of the boat so that when the macroeconomic waves come, when the tech sector throws a tantrum over interest rates, you don't capsize. You just collect your quarterly dividends and reinvest them.
So the parachute is deployed, the profits are locked in, and the boat finally has some ballast. But just when you think the rotation is done, this investor makes their most decisive and honestly a most aggressive move yet.
Oh yeah, the big one.
Here's where it gets really interesting. They look at the remaining tech foundation, and they completely liquidate all 6 shares of Taiwan Semiconductor. TSM is entirely gone.
And this is the specific trade that signals a total paradigm shift in how this investor is calculating risk.
Let's break down why. Because TSM isn't just a software startup trading on hype. They physically manufacture the most advanced microchips on the planet. Everyone needs them.
They do, but the foundry business, The actual physical manufacturing of these microscopic chips is intensely cyclical and capital heavy. We're talking about capital expenditures or CapEx that are hard to even fathom.
Right.
Like TSM has to spend tens of billions of dollars just to build a single fabrication plant or fab before they even produce a single chip.
So the fixed costs of just keeping the lights on are astronomical.
Yes. I like to compare it to owning a commercial airline. When you buy a fleet of massive jetliners, the cost to fly them from New York to London is roughly the same whether the plane is 100% full or 40% full.
Because you still have to pay the crew and fuel it up.
Exactly. You still have to pay for the fuel, the pilots, the plane itself. Foundries work the exact same way. If global demand for electronics is booming and the fabs are running at maximum capacity, it is a license to print money.
But if things slow down...
If demand dips even slightly, and those factories are running at 70% capacity, those massive fixed costs eat your profit margins alive.
Wow. Plus, we can't ignore where those foundries are physically located.
The geopolitical elephant in the room?
Yeah.
TSM's most advanced cutting-edge manufacturing capabilities are deeply concentrated in Taiwan. The complex geopolitical tensions surrounding that specific region mean that as an investor, you are carrying a massive, unquantifiable risk factor on your balance sheet.
Right, it's out of your control.
Completely.
Oh.
The company could deliver the greatest earnings report in the history of capitalism, but if a geopolitical event occurs in the South China Sea, the stock is going to react violently.
So the investor looks at TSM, sees the cyclical airline-style economics, looks at the geopolitical map and says, I'm out. They sell all 6 shares. And where does that freshly freed up cash go? Straight into a brand new 11-share position in Johnson & Johnson, J&J.
A huge shift.
To me, this is the ultimate real estate metaphor. It is exactly like moving out of a glittering, ultra-modern glass penthouse that just happens to be built directly on top of an active geopolitical fault line and taking all that equity to buy a reinforced concrete bunker in the Midwest.
The contrast in the underlying business mechanics couldn't be starker. We just outlined the massive volatility and capital intensity of advanced chip making. Now look at Johnson & Johnson. This is a globally diversified healthcare giant. It is the definition of recession-resistant cash flow.
Because no matter what happens with inflation or consumer sentiment or interest rates, human biology doesn't care. People still get sick.
That is the core thesis. If the economy goes into a severe recession, everyday consumers might decide to delay buying that brand new $1,000 smartphone for another year. And that delay ripples backward and crushes the semiconductor supply chain. They might cancel a software subscription, but they do not cancel their medical treatments.
No, you can't afford to.
Right. They do not stop purchasing essential pharmaceuticals or life-saving medical devices or basic healthcare products. J&J provides a product suite that is almost entirely disconnected from the discretionary spending cycle of the average consumer.
So going back to our earlier metaphor, if SCHD and IBM added some weight to the boat, J&J is basically a solid lead keel bolted to the bottom of this portfolio.
It is practically bulletproof. It operates with immense global scale, it pays a rock-solid growing dividend, and its revenue streams are diversified across multiple different healthcare sectors. It is the perfect counterbalance to the high beta tech that dominated their original holdings.
So what does this all mean? Let's take a step back and look at the dust settling on this rapid-fire overhaul. Let's review the new equilibrium of this portfolio because it looks fundamentally different than the starting line we discussed 20 minutes ago.
Oh, the DNA of the asset allocation has been completely rewritten.
It really has. The new roster is heavily anchored by this powerful defensive engine. You've got Johnson & Johnson, you've got PepsiCo, Berkshire Hathaway Class B shares, and the SCHD dividend ETF. That is a fortress of value.
It is.
But on the other side of the scale, they didn't abandon innovation completely. They kept a few high-moat tech holdouts. Alphabet and Palo Alto networks are still there. And they maintained a couple of unique growth outposts, specifically Dutch Bros and SpaceX. But I have to zero in on what looks like a glaring, massive contradiction in their strategy.
Okay, where do you see the contradiction?
Well, we just spent this entire deep dive talking about how the investor aggressively wanted to shed the volatility of the chip and hardware space, right? They dumped TSM because of cyclical risks. They dumped NVIDIA. They dumped Palantir. If they hate semiconductor volatility so much, why on earth did they hold on to ASML? Isn't ASML quite literally the biggest semiconductor equipment stock in Europe? Aren't they caught in the exact same cyclical trap?
This raises an important question, and it's a nuance that trips up a massive amount of people when they look at the semiconductor industry.
Yeah.
They view tech and chips as one giant monolithic entity. But The brilliance of this investor keeping ASML while actively dumping NVIDIA and TSM comes down to understanding exactly where a company sits in the supply chain.
Okay, lay it out for me.
You have to differentiate between the volatile chip designers and the vulnerable foundries versus the impenetrable infrastructure that allows the entire ecosystem to exist in the first place.
Wait, so if NVIDIA is designing the brain of the AI and TSM is the muscle actually building it, ASML is just making the scalpel they use to do the surgery.
Better yet, ASML is the only company on the entire planet that knows how to forge the scalpel.
Oh, wow.
Yeah. NVIDIA designs chips. TSM manufactures them.
Uh-huh.
Both of those companies are fighting in the trenches. They are dealing with shifting consumer demand, fierce global competition, and the cyclical gluts we talked about.
Yeah.
ASML does not design chips, and they don't mass produce them for consumer electronics.
Make the machines.
Exactly. ASML makes the immensely complex machines that make the chips. Specifically, they hold a global monopoly on something called extreme ultraviolet, or EUV, lithography.
I know this involves some truly mind-bending physics.
It sounds like science fiction.
Mm-mm.
To print the microscopic circuits on modern advanced chips, ASML's machines shoot high-powered lasers at microscopic droplets of molten tin, vaporizing them into plasma to create a specific wavelength of light, which then acts like a highly precise stencil to draw circuits at the atomic level.
That is insane. So if you are a foundry and you want to build an advanced microchip for the next generation of AI or smartphones, you have to buy an ASML machine. There's no cheaper alternative you can pivot to.
There is zero alternative. It took ASML decades and billions of dollars in research and development to crack the physics required to make this work at commercial scale. That technological lead is what we call an economic moat. It is a giant, impenetrable castle wall around their business that prevents competitors from stealing their market share. So whether NVIDIA's new AI chip outsells AMD's, or whether a foundry in Taiwan loses an order to a new foundry being built in the United States, ASML simply does not care.
Because they supply all of them.
Because every single one of those players needs ASML's machines to operate.
Ah, that clicks perfectly. It's not a semiconductor stock in the traditional cyclical sense. It's the toll booth for the entire future of global computing.
Exactly. It is an infrastructure monopoly.
Yeah.
And that is why retaining ASML fits so perfectly into this new defensive philosophy. The investors systematically stripped away the high-beta, highly competitive, geopolitically sensitive layers of the tech stack. But they intentionally kept the one underlying piece of infrastructure that the entire global economy relies on to move forward.
So they didn't just throw their hands up and abandon the future for safety. It's a highly calculated hybrid blueprint. You build this massive, unshakable defensive value engine with J&J, Pepsi, and Berkshire to protect your downside and generate a constant stream of cash. But you maintain a foothold in the future by holding deep moat, monopolistic tech infrastructure like ASML.
I would argue that in today's highly uncertain macroeconomic environment, this hybrid approach might be the ultimate blueprint for tactical rebalancing. It acknowledges that technology is still going to drive the future of the economy, but it flatly refuses to overpay for hype or accept unnecessary cyclical risk to participate in that future.
It's an incredible journey to track. For you listening right now, I think the biggest takeaway here is a visceral reminder of the power of actively managing your risk.
Yeah.
Being a great investor isn't just about picking the winning stock at the bottom before everyone else discovers it. I mean, anyone can get lucky in a bull market.
Yeah, that's the easy part.
True wealth building is about knowing when the risk-to-reward ratio has fundamentally flipped against you. It's about having the emotional discipline to take those high-flying, exciting paper gains and deliberately convert them into bedrock, reality-based value that lets you sleep peacefully at night regardless of what the market does tomorrow.
The amateur investor plays a game of capturing high scores. The professional builds an all-weather compounding machine.
I love that distinction. Now, as we wrap up this deep dive, I must reiterate our mandatory disclaimer one more time. This entire discussion, analyzing this anonymous investor's portfolio, snapshots, and tactical moves, is strictly for informational and educational purposes only.
Just educational.
Right. Do not take this conversation as a roadmap for your own money. This is not financial, legal, or investment advice. You must consult a certified financial professional before making any moves or adjustments in your own portfolio.
And as you think about your own strategy moving forward, I want to leave you with one final, lingering question to ponder. We've spent this entire time analyzing and praising this investor for successfully rotating out of the overcrowded, hyped-up AI trade and finding safety in boring defensive value.
Yep.
But markets are ultimately driven by human herd behavior. If the economic skies darken globally and every major investor suddenly decides to seek that exact same safety, if hundreds of billions of dollars simultaneously rush into those exact same dividend and healthcare stocks, does that bulletproof ballast quietly become the market's next volatile bubble?
An incredible thought to leave on. That's why we always have to look one move ahead. Until next time, thanks for taking the deep dive with us.